Understanding the mechanics of financial institutions requires a close look at how yield is calculated and distributed across various account types. When evaluating deposit products, consumers frequently examine the distinction between payout schedules, looking closely at whether returns are credited to balances on a monthly or annual basis. Financial platforms structure their interest compounding and crediting intervals based on specific regulatory frameworks, institutional policies, and account structures designed to attract and retain depositor capital. The structure of interest payments governs how rapidly money grows over time through the power of compounding. Compounding frequency dictates how often accrued earnings are added to the principal balance, allowing subsequent periods to generate returns on a larger base. Institutions that utilize frequent crediting schedules allow account holders to realize the benefits of compounding at shorter intervals, which mathematically maximizes the effective annual yield compared to simple interest or delayed annual distributions. Savings and checking accounts typically operate under automated digital banking environments where interest calculations occur daily. Under a daily accrual method, the institution determines the customer's earnings at the end of each business day by applying a daily periodic rate to the ledger balance. Although the underlying math runs continuously behind the scenes, the actual deposition of those funds into the customer's accessible balance follows a predetermined institutional cycle. For most modern digital-first banking providers and high-yield accounts, interest is calculated daily and credited to the customer on a monthly basis. Monthly crediting cycles provide significant advantages for account holders. By depositing earnings at the conclusion of each calendar month, the bank ensures that the accumulated interest immediately joins the principal balance, thereby increasing the baseline value for the subsequent month's calculations. This monthly compounding schedule aligns with standard consumer budgeting cycles, allowing individuals to track their financial growth through regular monthly statements and digital dashboards. Examining the terminology used by financial institutions clarifies potential points of confusion regarding yields. The annual percentage yield, commonly abbreviated as APY, represents the total amount of interest paid by an institution based on the interest rate and the frequency of compounding over a 365-day period. While the term contains the word annual, this refers to the standardized yearly projection rather than the distribution schedule. An account displaying an annual percentage yield typically distributes earnings monthly, meaning the yearly figure is a normalized metric used to help consumers compare different financial products on an equal footing regardless of their specific payout intervals. Credit products and borrowing facilities managed by financial institutions utilize different tracking mechanisms for interest compared to deposit accounts. For credit cards, installment loans, or financing plans, interest is usually calculated daily based on the average daily balance and charged or added to the account at the end of each billing cycle, which typically spans a monthly interval. Conversely, specialized longer-term savings instruments or certificates of deposit might offer options for monthly payouts or cumulative annual compounding, depending on whether the account holder chooses to withdraw the generated income or reinvest it into the principal pool. Evaluating the precise schedule requires reviewing the specific disclosures and account holder agreements provided by the institution. Terms and conditions outline the exact day interest begins to accrue on deposited funds, the formula applied for daily balance determinations, and the exact calendar date or cycle point when earnings post to the active balance. Reviewing these details ensures complete transparency regarding how financial growth is realized over the lifespan of the account.